Our next guest calls a massive stimulus package the biggest risk to this rally. Let's bring in Mandy Zhu, Chief Equity Derivative Strategist at Credit Suisse. Mandy, great to have you with us. And specifically, you mean if we do not get a bill through, correct?
Yeah, so I would say this is by far the biggest risk factor for markets, certainly for the second half of this year. And what's interesting is actually in most of my recent client conversations, investor conversations, most people are actually fairly, I would say, complacent around this risk with the predominant view that, and I quote, something will get done, right? Congress will figure something out. But my pushback has been, that something, the specifics around that something, that really matters, right? Whether we ultimately end up with a $1 trillion package or something that's much bigger, that's going to have an impact on the economic recovery. And some investors think, regardless of the amount, the fact that the Congress is doing additional stimulus, that in itself should be bullish for markets. But again, my view is that, what matters for markets from here is the rate of change, right? If you're going from a $2 trillion stimulus that was in the original CARES Act now to a $1 trillion stimulus, that's a quite significant cut. So that's something that I'm watching very closely in terms of driving equity markets going forward.
And specifically, not just the headline number of the size of the deal, Mandy, but in terms of what is in the deal, I would imagine that the enhanced unemployment benefit is going to be key. Consumers will feel that difference. And as you mentioned, it's the rate of change. It's the change from what the status quo is now, which is $600 a week, to what it could be, which is Republicans are proposing $200. Let's say they split the difference and it becomes $400. Is that also a risk to the market that people are fairly complacent about?
Yeah, so I think you've identified one key component that we're watching very closely, which is the unemployment insurance supplement and just how far, how much it gets reduced from that $600. So I would say right now people are probably expecting final number around that 400. If it ends up being much lower than that, I think that's going to be a big risk for markets. Another thing that I don't hear a lot of people talking about, but I would put up there in terms of importance, is state and local aid, right? Without federal assistance, a lot of state and localities are going to have massive budget deficits. And, if that's not addressed, we're going to see job cuts starting at a state local level, and that's going to have an impact on the economic recovery as well. So that, to me, is another component that I'm watching, the state and local aid, in addition to the unemployment insurance.
The bright side to all of this is volatility is fairly low, Mandy. So are you recommending that investors actually put on some protection trade going into the next few days? I mean, what is sort of the recommendation out of all of this?
Yes, so absolutely. So I would say, I think last time I was on the show, I was talking about how everyone was talking about hedging the downside risk. Things have completely changed. I was almost 180. Nowadays, we're seeing very little interest in hedging, and I've actually been recommending to investors to look at downside hedges. Given, the decline in volatility, I do think this fiscal cliff is an underpriced risk to markets. I would say investor focus more recently has been more on tech earnings, especially coming up this week with a lot of the mega tech companies reporting. That's important for sure, given the dominance of tech in this recovery. But to me, again, in terms of what's going to drive the stock market for the second half of the year, it's the next fiscal stimulus bill and the risks around that. So what we have been doing is recommending people look at more tactical, shorter dated hedges in case we have a delay in fiscal stimulus or a significant reduction in the size of the stimulus bill.
Mandy, great to speak with you as always. Mandy Zhu,
great, thank you,
of Credit Suisse. Guy, what do you make of it? BK has been on this train for some time that this is the biggest risk. People are looking past this, assuming something gets done. You also have been assuming that something gets done. As we approach the deadline, are you maybe worried?
I'm worried about a lot of things. I mean, maybe I should be worried about this. I don't know. But I also know that we're within 100 days of an election, and the Republicans, and look, they can fight all they want, but we know that at the end of the day, they're going to have to get something done closer to $600 because people need to get elected. So Mitch McConnell can talk his fiscally responsible stuff all he wants. But the fact that they, it's amazing. This has nothing to do with Mandy, but the fact that we throw around trillions like it's nothing, it's remarkable. My question has always been, where are they getting this from? And the answer is something we're going to talk about later in the show. And that's why precious metals are moving. With that said, I do think it gets done. I think it gets done closer to 600 than to 200. And I don't think it's as much as a threat to the market as maybe BK or Mandy thinks.
Closer to 600 would be a real relief. I mean, the McDonald's CEO, I believe on the conference call, said something to the effect that that $600 stimulus check has helped McDonald's sales. And a reduction in that could also translate into reduced sales. So, Dan, 600 versus 400 may not seem like a lot to a lot of people, but it is.
It's a lot. It's on a weekly basis. It's also what a lot of these consumers have been relying on. They don't have a lot of savings, so there's going to be a pretty sharp drop-off in consumer behavior. We've already seen consumer sentiment data this week trend lower. It's not looking good month over month. I'll just make one other point. My good friend Pete Najarian from Minnesota, who I haven't seen in 7.5 months, and I know he is a freaky options trader here. To Mandy's point about protection in the market, if you were to look at the S&P 500, the SPY, the ETF that tracks it, and you're looking at the 321 put strike out in August, okay, August 31st, 1 month out, that cost you about 2.5%. So, to me, option premiums are pretty low considering all the potential headwinds that we see right now. And just to put it, in a nutshell, 5% implied move over the next month, that seems pretty easy. We could see that, but if you're only looking to protect, it's 2.5%. So to me, I think downside protection in the SPY, especially at this technical level, sitting right on that uptrend from the March lows, looks pretty reasonable to me.
Well, I think Dan's exactly right. And Dan, when you look at this and you look at that volatility index, I mean, we're not talking about too long ago where we actually were in the 80s for volatility, right? I mean, we looked at the VIX, it got up to 84 or maybe even a little bit higher than that, 60s, 40s, 30s, and here we are in the mid-20s. So the opportunity right now, I think, to buy some protection at the levels like you're talking about from a percentage basis, we can look at that and say, you know what, it's going to cost me the 2%. That's a great hedge because obviously these moves to the upside have been absolutely incredible. So with a VIX trading around 24, it makes total sense to me. And there are ways that you can spread it off. You wouldn't even have to put up that much more money if you were willing to spread it off, saying, I could see a sell-off, but it's not going to be an absolute hurricane to the downside. And that way you can even take in a little bit of the premium by buying a higher strike and selling a lower strike.